Hey guys, the world right now is in a terrible place. We're only just coming out of a pandemic, economic growth is stagnant, inflation and the cost of living is soaring, and warlord Putin has decided to turn the clocks back 100 years and throw Europe into a bloody and violent war.
Naturally, stock markets and investors are worried, but can you protect your portfolio from getting hammered? Also, with prices of everything going up massively, can you somehow hedge these inflation increases so your wealth rises as your food and energy bills go up?
The prices of commodities right now are soaring, and Reuters are saying that commodity funds are in demand as investors seek refuge from soaring inflation.
In this video, we're looking at the case for investing in commodities, how much they're going up, what commodities you can invest in, how you can invest in them, and how they protect you from both inflation and war. Let's check it out. This video is sponsored by BullionVault, the world's largest online investment gold service. With BullionVault, you can buy, sell and store your physical gold, silver, platinum and palladium in your choice of insured vaults in places like Zurich and London, and you can even withdraw your bullion to take physical possession.
Narrow price spreads and small fees mean you pay incredibly low costs to physically hold gold. Rated excellent on Trustpilot, BullionVault's users own more gold than all but 50 of the world's largest central banks, storing precious metals worth more than £2.9 billion.
Everyone who opens a BullionVault account with the offer link in the video description below will receive 4 grams of silver for free and find their online account preloaded with a small amount of cash to let you try buying and selling for free.
What is a commodity? Investopedia describe a commodity as a basic good used in commerce that is interchangeable with other commodities of the same type, like how any 2 baskets of wheat from anywhere in the world are basically the same. Commodities are the raw materials used to make most of the world's products, and hence their prices tend to rise along with retail prices and so hedge against inflation. Investors and traders can buy and sell commodities directly in the spot market or via derivatives such as futures and options.
Commodities can be categorized into either hard or soft varieties. Hard commodities are natural resources like oil, gold and rubber and are often mined or extracted. Soft commodities are agricultural products that can be grown and harvested, such as coffee, wheat or corn. But as investments, commodities are also often divided into more specific categories to account for their different purposes. These include energy, industrial metals, precious metals, agriculture and livestock.
How is a commodity price determined? Oil is basically the same product, regardless of the producer. So if Europe were to reduce their usage of Russian oil, it is possible that countries in Asia, such as China, could increase their imports of Russian oil.
Because there is little differentiation for any particular commodity, the price is primarily determined by the supply and demand. For example, a booming economy might lead to increased demand for oil and other energy commodities. Likewise, war can disrupt supply, sending the price skyward. Compare this to something like a mobile phone, which is a product. Here, the value and price will be based on many factors such as the brand, aesthetics, available apps, processing speed, camera quality, and much more.
2 big reasons why you should invest in commodities. Reason number 1, hedge against inflation and war. According to Barclays, by 2020, inflation had been running at low levels for several decades, which meant the price of commodities on average performed weakly. However, inflation is now casting a big shadow. We could argue that commodity prices are rising due to inflation, or rising commodity prices cause inflation. But either way, right now, we have rising inflation and rising commodity prices. Add to this the war and the sanctions imposed in response to it, these will aggravate inflation and cause massive disruption to supply chains globally.
This impressive chart shows the changes in commodity prices in 2022 so far. Energy prices are up 41%, agricultural prices are up 25%, industrial metals are up 22%, and precious metals are up 9%, perhaps with further to climb. The S&P GSCI index, which is one hell of a ridiculous name, is a commodity benchmark and is up 36%.
For reference, UK inflation is forecast to hit 8% in April, and in the US, which is what this chart shows, the trend has been rising inflation over the last year, with January's figure 7.5% and February's 7.9%. Other asset classes, which are typically considered inflation hedges, such as real estate and inflation-linked bonds, currently trade on historically very expensive valuations.
Reason number 2. Commodities diversify equity risk. According to longtermtrends.net, stocks and commodities are negatively correlated, and so great for diversification if you own some of both. Research found that equities and commodities alternate on leading the market on average every 18 years, which also corresponds to the lengths of deflationary and inflationary cycles as per this chart. The chart shows the stocks to commodities ratio.
When the ratio rises, stocks beat commodity returns, and when it falls, commodities beat stock returns. Over the long run, stocks clearly outperform commodities. That shouldn't come as a surprise, but it's interesting to see that during the inflation periods, commodities outperform.
With the recent commodity price boom, you may feel that you've missed the boat, but as we've just seen, these trends can run for many years, and if we're only at the start, then now could be a great time to buy into commodities. We never pretend that we can time the market, so we prefer to make sure that we have a balanced portfolio all the time, which is why we always have some commodities in the Money Unshackled Ultimate ETF portfolio, and in the Money Unshackled Leveraged portfolio.
We ran some backtests for the last 50 years for a portfolio consisting of 100% US large cap stocks versus 100% gold versus an 80-20 portfolio of US stocks and gold. We would rebalance the blended portfolio every quarter. The results were very surprising.
Over the long term, the stocks had smashed it. Gold, too, had done really well, but significantly below the performance of stocks. But interestingly, the blended 80-20 portfolio performed slightly better than 100% stocks, resulting in an even bigger final balance. Moreover, incredibly, it did this with lower volatility and a smaller max drawdown, which is the decline from peak to trough. This goes to show that diversification doesn't have to reduce returns, but can actually lower risk and increase returns. It's a win-win. Gold may have had the highest volatility on its own, but combined into a portfolio, it reduced overall volatility.
How to invest in commodities. Personally, we think investing in commodities can be super complicated depending on what you want to invest in. Commodities can be traded in the futures market, which means you need to understand concepts like roll yield, contango, and backwardation. A few years back, I stopped investing in commodity ETFs which used futures because I couldn't quantify the impact of contango. When using futures, an investor must regularly roll their contract over to a future contract. If this contract is priced higher than the one the investor is selling, there is a negative roll yield, which means the investor essentially loses money each and every time this occurs.
Some commodities, like wheat and corn, can't exactly be stored for long before they rot, so your investment options will be limited to the futures market, even if you invest indirectly through an ETF. And who wants to fill their house with bushels of wheat? However, precious metals like gold, silver, platinum and palladium can be stored easily and crucially don't spoil, which is why precious metals are our preferred commodities to invest in.
One option you have is to invest using physical ETFs, and using the ETF screener at JustETF.com is a good place to do your research. ETFs are low cost and convenient, but the underlying metal is not allocated to you, and you definitely can't take physical possession with an ETF. As gold bugs like to argue, if you don't hold the gold, you don't own the gold.
You could buy and store precious metals yourself, but this has a ton of drawbacks, including high costs, risk of theft and inconvenience. Perhaps a better balance between this and an ETF is to use a service like that offered by BullionVault. These types of services allow you to buy, sell and store precious metals, and BullionVault, for instance, even allows you to take physical possession.
Our preferred way to invest in energy would be to gain exposure indirectly through oil and gas stocks, or better still, an ETF tracking the sector. If the commodity rises in price, the companies producing that commodity may experience increased revenues and profits, and the share price should reflect this. As we saw earlier, energy prices have surged. This chart shows the ETF performance of the Xtrackers MSCI World Energy ETF. It's up 46% in a year, and almost all of that was in the last 6 months.
However, be very careful of individual stocks when attempting to track commodity prices. BP has taken a massive beating recently due to its share of Russian oil giant Rosneft, which it will now dispose of, resulting in a write-down of up to $25 billion.
If you wanted to invest in a basket of different types of commodities, your best bet is likely to be an ETF, but remember the drawbacks we said earlier about futures and contango. If you still want to invest in a basket of commodities, you should check out the helpful guide at justetf.com, which we'll link to below. In the past, I've invested in the LNG All Commodities ETF as it's very cheap and it's very diversified across multiple commodities, but that is not a recommendation and I'm currently not invested in it.
Which commodities should you invest in? Oil. We've always been bullish on oil. When COVID hit and oil plummeted to around $20 a barrel, we released a video called "Oil is low, buy, buy, buy." We obviously would love to reduce the world's dependency on oil, and one day renewables will probably do that, but it was obvious then, as it is now, that the world still runs on oil.
Today though, oil might not have such a compelling case to invest. Brent crude is currently priced around $105 a barrel, briefly reached $130 a barrel, and the overall trend is rapidly moving towards its all-time high. A tweet from Cathie Wood dated July 2020 was being mocked recently as it hasn't aged well. She said oil demand probably hit a secular peak last year, and thanks to EVs, that's electric vehicles, it is now in a secular decline. Her prediction was $12 a barrel. The war Russia started will only strengthen the West's resolve to wean itself of oil and move faster towards renewables. Energy dependency is now being rightfully recognised as a security issue. At some point, Cathie Wood's prediction will probably come right, but that's not happening anytime soon.
Gold and silver. If we were only to invest in one or two commodities, it would be gold and silver, with a main focus on gold. Silver is gold's more volatile cousin. Their prices generally move in the same direction day to day, but the size of their fluctuations varies greatly. Over the last half a century, gold has averaged a daily move of 0.5%, up or down in US dollar terms, but silver has moved more than 0.9%.
Is gold a substitute for all commodities? Andrew Craig, author of How to Own the World for One, argues that with its historical role as physical money and its links to the banking system, gold on its own fulfills many of the purposes of a diversified basket of commodities.
Palladium. Despite being relatively unknown compared to gold among retail investors, palladium actually overtook gold as the most expensive precious metal in January 2019 and is now worth $3,000 per ounce. Palladium is used as an integral component for producing catalytic converters in the automotive industry. This accounts for about 86% of mined palladium, according to some estimates. It is also used, to a far lesser extent, in electronics, dentistry and jewellery.
Palladium is rarer than gold and silver, but compounding its rarity is the fact that 44% of palladium is mined in Russia and 40% in South Africa, with most of the rest coming from the US and Canada. Depending how the world responds to war with Russia, we could see prices surge even more as all the pricing power shifts to a single country, South Africa.
Platinum. Platinum is also rarer than gold. Only 1 ounce of platinum has ever been mined for every 30 ounces of gold. The uses of platinum vary much more than those of palladium, but still around 40% of demand comes from the automotive industry. 24% is used in jewellery.
Global mine production is dominated by South Africa at 75%, Russia and Zimbabwe come in second and third at 9% and 8% respectively, so less likely to be impacted by the war than palladium in our view.
Question of the day: do you invest in commodities? And if not, why not? Join the conversation in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.